Thanks for joining us on Digging for Value. I'm Allison Southwick, joined by Taylor Muckerman and Joel South, our energy analysts here at the Motley Fool. So today we're going to talk about energy stocks that are making some moves. We're also going to answer your questions, but first, of course, our top story with the headlines. Wall Street Journal is reporting today that U.S. to pass Russia in liquid fuels production, says the International Energy Agency. So the article goes on to say that essentially the U.S. is kicking tuchus again as a global energy powerhouse. America is back, baby, right? Yeah?
Absolutely.
So what's going on here?
Yeah, it's interesting. If you look at Russia historically, that's been the country with all the resources. They've had natural gas in excess quantities. They've had oil, shale, and conventional oil in excess quantities. And really, besides Saudi Arabia, they have been the dominant player. Now that you're seeing a lot of the technological advances in the United States, we're finally coming over and taking over the liquids, not the natural gas, but the actual liquids, which is huge. So that we're talking about crude oil, natural gas liquids, and even going into biofuels, which is very nice. And so when you're looking at what this means long term, you're basically looking at what we've done in areas like the Eagle Ford and the Bakken by using hydraulic fracturing and horizontal drilling to really get a lot of these resources that other countries have not been able to crack the code of. What I really like about this long term, this really helps American companies position very nicely overseas. You can look at ExxonMobil and Rosneft, which is the national oil company in Russia. Basically, they need the expertise that ExxonMobil has, so they're bringing them over and putting together multi-billion-dollar deals, giving Exxon a lot of ownership rights in the country because they are the ones that can go out and extract in tough-to-hit locales. So over time, if you look at the actual shale plays, we're not the biggest player. Russia actually has over 70 billion barrels of oil in shale that they can't really get to. So you look at companies like Halliburton that has a lot of the expertise that can continually increase, get better in that areas, and go and attack these areas. So I think the big story here is by us being on the cutting edge of the technology, we're going and really taking advantage on a number of other countries' resources and just showing what we've done at home and actually increasing and beating Russia in the next quarter, I think really shows where we've went and where we're going, and I think it's fantastic.
So then it's not just about what we're sitting on here in America, it's what we've learned that we can then basically export to other countries. It's not just the liquids, it's our brains.
Exactly. It's the technology and really being cutting edge, and just like in the technology sector and a number of other sectors, really improving on that and bringing it elsewhere and really gaining for the long term.
Cool. All right, next up, Reuters is reporting that U.S. solar panel installations are up 15% in the second quarter. So the uptick was due to a growth in utility scale systems as opposed to residential or commercial demand. So Taylor, before you tell me who this is good news for and what companies we should watch, can you kind of explain the differences here between utility scale, consumer?
Sure, yeah. Well, when you're looking at utility scale, that's basically a project large enough in scale that a utility is going to be interested in purchasing the energy being generated by that facility and then distributing it to their customers rather than the solar facility simply distributing the energy themselves. So you're looking at that being over 50% of the 832 megawatts that were installed in the latest quarter. It's a record quarter for solar. Very beneficial news for the industry as a whole.
And what companies, particularly when you saw this, did you think, oh, here's some guys who are going to benefit?
Well, when I looked at it and I saw utility scale, I immediately thought First Solar. This is a company where that's really their bread and butter, not just in the United States, but around the world as well. But with this company, you have to kind of keep an eye on their backlog because they did see from the beginning of this year till the beginning of August, their backlog dropped from 2.6 gigawatts to 2.2 gigawatts. So if they don't revamp that and build that back up, investors might lose a little bit of running room here as far as transparency and where the revenue is going to come from down the line. So when you look at the residential and non-residential side, flatlining and even declining just a bit when it comes to non-residential, you start to worry about a Solar City, which is leasing and really pioneering the leasing business here to residential customers. But I think they've recognized this and they've branched out a little bit with recent deals with the town of East Bridgewater, Massachusetts, and Direct Energy to attack some of their business customers that they cater to in 14 states and Canada. So both of those companies have a little bit of different opinions on the news today, but overall industry trends are very beneficial for the movement of renewable energy.
Cool. All right, our next headline. Wall Street Journal is reporting that the EPA plans to curb new coal-fired power plants. Basically, the EPA is proposing a new rule that would block new construction of coal power plants unless they can cut the typical carbon dioxide emissions by half. I'm kind of simplifying that. But, and of course, the coal industry thinks that the demands are unreasonable.
Sure.
So are they right here?
It seems like they might be, because currently there's no coal-powered power plant that even operates on a commercial level that can meet these standards. You see Southern Company really pioneering carbon capture and storage when it comes to coal-fired plants, but they have only one facility down in Mississippi that's even close to being online for this. And they have a set of unique circumstances, being close to oil fields where they can store the carbon, and a few other things that don't really translate well to other companies and their coal-fired power plants. So you have to be a little bit worried for companies like American Electric Power, which has over 60% of its generation from coal, Duke Energy, which is around 37% in its latest quarter. So both of those companies really need to get on with moving forward with either carbon capture or really moving forward with natural gas. Southern Company CEO spoke at a conference here in DC, and he said that he's all in on natural gas. So they're starting to pull away from coal a little bit, even though they want a complete portfolio with renewable natural gas and coal. They really see that coal might be losing some of its legs here.
Yeah, definitely. Going on top of that, with that talk you're talking about, basically when you're looking at Southern Company, they want to go out and, even with their coal, and use that carbon capture. They want to turn in that carbon and use it into CO2 injections into oil fields. But even then, it's a great idea. Is it economically feasible? Can you actually get the CO2 into fields? So that's another thing you really have to watch in. It's a technology that, in theory, is great and it could work and really help out the coal industry, but getting it to the fields, I think, is the biggest key over the long term.
Yeah, none of this has been proven, so we'll see.
Yeah, right. Poor coal. They're in a tough situation lately, huh? All right, our final headline here is Bloomberg. The CEO of Valero has asked the Obama administration to waive the ethanol mandate. So basically the CEO is saying that the cost of ethanol have skyrocketed, and attempts to meet the mandate will mean higher costs of fuel for consumers, which companies always like to say, oh, we're thinking of our customers here,
Exactly.
and
It's
we'll
gonna
have
hurt
to
them.
raise
It's
the
gonna
price
hurt
for
them.
them. So if you want to hurt customers, the good people of the United States. So, but seriously, like, what is that issue here with the whole rising cost of ethanol? I mean, really, should we believe Valero here?
Well, what it is it's actually the renewable identification numbers. What the EPA is requiring is about 13 billion gallons of ethanol that needs to be mixed into gasoline. Once you mix it, you can actually take the identification number, which shows that you actually mixed it, or if you don't have the capabilities to actually mix it, you can buy these on the open market. So by having refiners that don't have that capability, they have to go out and buy these on the open market, which has sent the price of the renewable identification numbers really skyrocketing. Beginning of the year, they're about 3 cents per RIN, and now they're up to about 70 cents. So that's what's worrisome. And the biggest thing about this is the EPA expects demand to keep increasing, but if you look in the United States over the last 5 years, gasoline demand has actually been shrinking. So they're coming up to this wall where they can't produce as much because cars can only take a certain amount of ethanol in the gasoline. So the worry is if you keep increasing, you don't cut or give the waivers, that cost will soar. So if you look at some of the companies over the last quarter, you can look at Marathon Petroleum. They basically cost for mixing ethanol into their gasoline doubled over what it was in the beginning of 2012. Yes, that will be passed down to consumers. I'm not sure exactly how much that will be. Phillips 66 is another company that basically is estimating about $250 million in increased costs. So yeah, this is a big worry, especially since refiners don't have access to as cheap of crude as they had over 2012 and even in the beginning of this year. So they will pass on some of this cost. However, do they really need this? That's really to be seen. Obviously, Valero doesn't want any excess costs or any of these refiners. So to see what's actually mandated and see if the EPA actually pulls back, like they did this year, they were actually supposed to put more ethanol. They actually reduced the numbers. They're supposed to continually increase through 2022. So we'll see long term if they actually pull back on that and see if some of these refiners actually start going out and getting more ethanol and improving the facilities to process it. So that's the big worry overall with the refiners and gasoline prices.
Yeah, what's really interesting, I think, is that we're up against the wall in my mind already, because in 2012, already 9.7% of gasoline sold at the pump was ethanol, and you look at automotive manufacturers saying that 10% is the cap right here. Toyota already puts a logo on 2012 models and and further on that don't use anything higher than E10 gasoline. So they're already notifying their consumers that, hey, if it goes up to the 15% that the government says we might have to bump up to, it might not be very good for your car. So, and for Valero, I mean, they're the third largest ethanol producer behind Archer Daniel Midland. And so to see them come out and say this really speaks volumes for the line that we're up against.
All right, well, that covers it for the headlines today. Now it's time to take a look at some of the stocks that are popping and dropping. So starting off with Dominion Resource. It is up about 2% right now. And so, Taylor, what is the story here? What happened?
Well, just yesterday, the Department of Energy allowed them to export LNG, liquefied natural gas, to countries that we don't have a free trade agreement with. They've already been exporting on smaller levels to countries that we do have agreements with. But now this big boom here that you've seen over the last few months with Cheniere Energy, Freeport LNG, a combination of Dow Chemical and Chevron, and then you also look at Energy Transfer Partners has a facility down in the Gulf Coast as well. So those three deals right now, followed by Dominion. Now we have over 6.3 billion cubic feet per day of natural gas approved for export. So that's almost 10% of our total production right now, and that's rising to the cap that you've seen in estimates from Goldman Sachs and Merrill Lynch saying that 7 to 8 billion cubic feet per day might be the cap over the next few years. So we're almost there, and that's why they're up, because this is the first East Coast facility to be approved. While it is the smallest approval, they've been waiting quite a while for it, so investors are definitely happy to see this be approved.
Yeah, it's definitely interesting. Since Ernest Moniz, the new Department of Energy Secretary, has been in his seat, there's already been 2 approvals. Previous 2 years, there was only 1.
Right.
So this has actually been a big boon. If you look at Encana today, they're up about 8%, big natural gas company. And basically, with the amount of approvals that are coming out, this could be a big boon for natural gas prices to start increasing, especially with the exports coming online. So, it could be good news for a lot of producers as well.
I think so.
All right, our big stock dropping today is Halcone. It's down about 4% right now. And Joel, what is behind the drop?
Yeah, definitely. This is a company that actually came out and had asset sales, and it's about $3 million for some non-core assets that they had. And basically, when that happened, the stock actually increased because this is a company that has been diluting their shareholders a little bit with a lot of equity issuings. So people were expecting this money to go back into some of the new areas. However, yes, this is going to hurt them. It's about 4,500 barrels of oil equivalent per day of production. That's about a little over 12% of what they're actually producing this quarter. So yes, it is a hurt. It does hurt if you look over for the short term, because it's a small growing company. Any production numbers will take effect or will affect the company. So that's really what the worry was. However, if you look at what Floyd Wilson, as the CEO, has done with companies before and this company, he's very good at going and grabbing de-risked assets, which is areas that are already proven. People know oil's there, drilling them and turning around that and with the liquids plays and increasing that way. So he has a history of really finding the great areas. He still has his core assets in the Eagle Ford and the Bakken, and some in the Utica as well. So I would trust what he's doing, taking that money and going back and really getting into the core plays where he gets the best ROI out of it. So short term, yes, this is a little hit. It's better than some of the equity issuings, I would think. But over the long term, I still have faith in one of the best managers in the oil and gas space. So this is another drop, but it shouldn't really affect the business at all.
Maybe a little bit of a buy opportunity,
Definitely.
or definitely a buy.
I'm a shareholder of this company, and I do think that long term that it will pay off.
Cool.
Great. All right, so now it is time to head to the mailbag for your questions. Time for a little segment we call Ask a Fool. If you want to ask us a question, just head to our Facebook page. You can post it on our wall, or you can also shoot us an email to askafool@fool.com. All right, so the first question is going to Taylor. Stephen.
Let's have it.
All right, Stephen Katzev wants to know, is it a good idea to invest in emerging domestic oil and gas companies?
I think when you're looking at this space, you really have to do your due diligence, because they are unproven for the most part when you're getting into this. But the company Joel was just talking about, Halcone, is a fine example of an emerging domestic oil company that you can have faith in because of the management team that he already touted. You can look at a company like EOG that started off in that mold and has really grown into a broad domestic producer with great diversity here in the United States, operating some of the best plays in the country. And then a company that might be following in their footsteps, Kodiak Oil and Gas, Williston Basin and Bakken a heavy producer that's just been doing great things up there. They've kind of been pioneering pad drilling in the Bakken. They started off that back in the mid-2000s, and now they're up to 8 wells per pad as what they're testing out right now, up from 4. So they're really expanding. But there are some companies that really haven't done so well. So like I said, due diligence is of the utmost importance when you're looking at companies that are going out there exploring and producing oil in this country.
So is there any like specific red flag that Steve should keep an eye out for, or?
You really want to
There's
pay
probably
attention to
many.
the balance sheet first and foremost. Make sure that they're handling their capital in a wise manner, not taking on overabundance of debt. You saw Chesapeake and Sandridge are prime examples of companies that did that, and they had to take a couple years back and really try and revamp their balance sheet there. And now they're finally getting their footing and producing at levels that investors are happy to see. But that 2-year gap really did hurt share performance. So you got to make sure that the balance sheet is in order.
All right. The next question comes from Sid via email. Joel, he wants to know, why is Northern Tier Energy plunging? Is it because of the narrowing spread between West Texas Intermediate and Western Canadian Select, or that planned cracking unit shutdown in October? Is this a buying opportunity?
Well, this is an interesting question. Obviously, with the planned shutdown, that's already been factored into the share price, so I don't think that's really what's holding it back. I think they're just in the same boat as a lot of other refiners where the access to cheap crude is not there anymore. When the WTI, which is the United States benchmark price, was significantly under the international price, a lot of our refiners did very well because they could compete at a lot better position than a lot of international players. This is a company that has about 53% of their oil is light sweet, basically from the Bakken. That used to be very advantageous, but a lot of the takeaway capacity has been moved to the Gulf Coast. That's not as great anymore. The rest of their oil comes from the Canadian oil sands. Also, long term, this has been very beneficial. That's also starting to close a little bit. And I think by having the crude actually start matching up better with international prices has been the main driver of why the share price has dropped quite a bit. Is it a buying opportunity? I'm not quite sure there. This is a company that only has one refiner, so any shutdown can really hurt it. I mean, you could look at what CVR Partners did in their agriculture business. They only have a couple facilities. When one shuts down, it really affects their business. And being a master limited partnership, those basically their income is distributed to unit holders, so that really hurts them more than if they were a normal traded company.
Mm-hmm.
So I think that's what's really held them back. Like I said, being one facility, that's 75% of their revenue. That really should be worrisome. You really want to be in a diversified company. You know, they do have close to 200 retail stores, but you know, there's not a whole lot of great margins there. So I think that's what's really hurting them. This is a company that has about a 12% yield. When you have that high of a yield and you're required to return those distributions to a company, and you have some shutdowns and potential closing in the WTI prices, I think that's what's really holding them back. Long term, it's kind of hard to say. I'm not sure it would be a buying opportunity.
So are there any peers to Northern Tier Energy that Sid should take a look at?
Well, this is one of the only refiners in the MLP space, so if you're looking for a yield, I would suggest looking into other MLPs in, say, natural gas or product pipelines that have good yields, have long-term contracts that you can count on those yields. If you're looking for a good refiner, I would look in more of a diversified refiner like a Valero. That's one of the largest independent refiner, or a Phillips 66 that is diversified not only in the number of refineries, but they have a great chemicals business that's JV with Chevron, and that's really expanding and has great margins there. So I would look in something a little bit more diversified.
All right. Well, guys, I think that covers it for today, unless you have anything else you want to add.
I think we're good.
All right. Wonderful. Well, for Taylor and Joel, I'm Allison Southwick. Thanks for watching.